I've invested in a lot of tax abatement multifamily opportunities. So I didn't invest in any floating rate bridge loan deals at all. On the multifamily side, I did do fixed rate 10-year tax abated opportunities that just create an immense amount of cushion at closing. They're very unique.
Are you looking to achieve massive success in your life without dealing with costly investment nightmares? If yes, then this is the podcast for you. Here, we provide engineers and busy professionals all the secrets and strategies to create multiple streams of income, build generational wealth, and live a meaningful life by design. Here's your host, Ted Patel.
Decoding Cash Flow listeners, welcome back. Today's episode is going to be an absolutely spectacular, and there is a tremendous value in this conversation. If you want to learn from one of the best passive investor, you come to the right place. Our today's guest is Jeremy Roll. Jeremy has started investing in real estate and businesses back in 2002 and left the corporate world in 2007 to become the full-time passive cash flow investor. He's currently an investor in more than 60 opportunities across more than $1 billion worth of real estate and business assets. As a founder and president of Roll Investment Group, Jeremy manages a group of over 1,500 investors who seek passive /managed cash flow investment in real estate and business. He's also a co-founder of For Investors by Investors, a nonprofit organization that facilitates networking and learning among real estate investors. He has an MBA from Wharton School and is an advisor for Realty Mogul, the largest real estate crowding website in the US. Jeremy, welcome to Decoding Cash Flow. It's a pleasure having you on the show.
Oh, thanks for having me on. I appreciate it. I hope our episode's helpful for your listeners.
All right. Yep. So I hope I didn't miss anything about your background. If you want to add anything.
All right. All good. Yep.
Okay. All right. So, Jeremy, before we dive deep into any of the economic cycle or passive investment, real estate investments, if you like to give our listeners a little bit background about yourself, how did you get started in the passive investment space, and where do you stand as of now?
Yeah, sure. So thanks again for having me on. I appreciate it. Just for everybody listening, I mean, just a disclaimer, I'm not a financial advisor, investment advisor, accountant, or attorney or anything. So this is just my perspective as an investor, not financial advice or anything. So I got started back in 2002, which was a long time ago now. And I got started on the passive side for two reasons. Just looking for alternative investments to be out of the stock market. Really, after the dot-com crash, I was kind of sick and tired of the stock market due to the volatility and the lack of predictability. And the lack of predictability was really what bothered me the most, because I was trying to invest for the long term for my retirement account, and to watch the stock market go up and down 30% from the dot-com crash in a year just wasn't the right fit for me. So that's how I ended up down this path, looking for more predictability. That's why I focus on predictable cash flow. And I think your second question was, what was it again?
Where do you stand right now? Like what? What's your main focus on right now?
Yeah, well, it's funny because literally where I stand is on the sidelines right now, pretty much for the most part. I'm still making investments like I always do, but it's a much lower volume. They have to be extremely unique. And my opinion, I try to read a lot of news every day and just come up with probabilities. And I try to go with the highest probability scenario, what I follow. And so my opinion is that we have high probability of recession, likely sometime in 2024. And I think we have two dominoes that are going to fall to reset this current cycle. One of them fell already, which is the interest rate increase. Mm-hmm. And that's caused a crash in real estate prices. And I use the word crash. I've decided I'm going to start using the word crash because no one's using it and it's actually accurate. Asset prices are down 20 to 30%. That's pretty much a crash. The other piece I think that hasn't fallen yet, the other domino, is recession. And what happens in normal recession times to revenues, expenses, NOIs, et cetera. So I'm waiting to see that second piece because I'm concerned that asset prices will continue to go down as a result.
No, you're absolutely right. We have seen in the real estate, okay, my personal opinion, I've seen asset prices going down, especially for the multifamilies. We are also doing some new construction, in New Jersey. It's a ground up new construction for luxury single family homes, as well as, small multifamily construction, mid-size, I would say, not small, around 20, 25 units. So we have seen a decrease of about 5 to 10%, especially in the New Jersey market. But I would say it's more about market specific. There are certain markets in where the prices went like, crazy during the COVID
Yeah.
period. Those are
Yes.
more prone to get
Oh yeah,
impacted.
for
So
sure.
yeah. And what do you think about the interest rates? Is it going to stay sideways for a while, or do you see any other 25 basis or 50 basis point jump in the near
Yeah,
future?
it's a great question, and of course, nobody knows for sure. I would say if you look historically at the amount of inflation we had, once you end up in over the 8% range, that type of thing, you typically end up with a double dip. And so, just historically, you shouldn't expect that the inflation goes up and then just goes down and everybody's done. Normally, what happens is that it goes up, it goes down, and then it goes up again, and then it goes down. And the problem is that the Fed is trying to avoid that, up, down, and then up again. And in order to do so, it has to keep the rates higher for longer to make sure that doesn't happen. But it also may need to increase rates again to counter that going up one more time. And so if you look at the closest measure that the Fed looks at, which is the core PCE, essentially that's been in the 4 to 5% range flat, literally since the beginning of 2023. And that's why the Fed has been so hawkish and looking at things carefully. So I think the risk is that I think most people have assumed that the rates are just going to go up and come down. But I got to be honest, like if you look probability wise, that's not the probability scenario. In the past 2 times we had this type of situation, it's up, down, and up both times. So I am very concerned about that second up leg, because if that were to happen, that would imply interest rates being higher at some point in the future than they are today, even. And we're recording this in November 2023, so they're very high right now. Residential mortgage rates are about 8%, maybe 7.5 to 8, because we just had a bit of a decrease. But the 10-year Treasury is about 4.5, so I think there is some risk to be careful with rates having to go up more. I'm watching the war in the Middle East very carefully, because oil can impact causing inflation across many different things. And if that happens, then that's where you could potentially get that next leg up. So I'm watching that very carefully. And also I'm watching one thing. There's an election year next year in the US. And the one thing also hasn't been discussed very much is there's been a ton of stimulus money printed by Biden this year. And if he elects to do that again next year, because it's an election year, to try to postpone or avoid the recession, which is very possible, that is literally working against the Fed, right? It's causing inflation. And so that's another reason why the Fed may need to raise further or hold these high rates for longer. So to me, like the scenarios from a probability perspective, taking historical, is that we either go higher for longer or we go higher, even higher from here. And the scenario, the most probable scenario is not that we go down practically at all in 2024. It is possible second half, but it would have to be like all the stars align, none of this other stuff happens. So we'll see.
Yeah. No, you're absolutely right, right? Biden administration, they don't want the recession before the election. So they'll do anything to stop the recession, to push it back a little bit. But the other scenario is, right, how can US serve the debt at this high rate? Because there's a ton of debt, right? They have to serve that debt. So is it possible that it's sustainable?
Well, how they can serve the debt is to print money. And that's the thing people have to understand. They can choose to keep doing what they're doing, is printing more and more money, right? And I'm not like a conspiracy theorist, we're going to have hyperinflation either way. I'm just trying to follow with the most probable scenarios. But to me, that's a very easy, it's been the easy solution for decades, right? And that's just another easy solution. And so that's how they can do that. So if the rates have to stay higher for longer, you just print money to cover it instead, essentially. And when I say print money, essentially what I mean is that they're issuing money. And the more money they issue, technically speaking, the more pressure there is for the rates to go higher, because I don't want to make it seem, it's not true to say, poof, they print money. They actually have to sell treasuries to print the money, right? And that impacts supply and demand, and it could impact interest rates going higher. But the ironic, easy solution to paying more interest is to then have to generate more treasuries that will maybe be at a higher interest rate.
Yeah. And of course, if they print more money, the inflation might also go higher, right? Because it needs to balance out somehow.
Yes. And so Yeah, there's a lot of risks right now, and I think because it's an election year, specifically next year, I don't necessarily take it as a foregone conclusion that we're going to have a recession, even though the normal numbers would tell you that's a high probability scenario, because of the fact that they can print their way out of a recession next year if they choose to. And make no mistake about it, there has been, I don't remember the names of these initiatives, but there's been trillions of dollars of stimulus in 2023 that people don't realize. There was the Strategic Oil Petroleum Reserve that was actually run down and released to be able to keep the price of oil lower, to be able to reduce inflation more quickly. That was kind of done in the background. That's kind of that game has been played and it's done. There's no more powder left, to be able to do that, dry powder. There was the green initiative, the ESG initiative for I think $1 billion or $2 billion that's starting to roll out. That is stimulus that happens over the course of years, but stimulus nonetheless, and it did start this year and it's going to be impacting next year. But they can do more stuff if they choose to. So we'll have to see.
Yeah. And what do you think about the Bank of Japan? I've seen like recently they are turning their rates into positive territory. They are increasing little by little.
Yes.
What do you see the impact of that on our U.S. Treasury bonds and interest
Yeah,
rates?
that's tough to say. And I say this because if you look historically what Japan has done, although they did keep a very similar stance and monetary stance and policy for many, many years and decades. At the same time, often in the past, they talked about doing something, then they didn't do it because because they just couldn't afford to do it because, man, they have a huge debt problem, right? They were testing the market. So in Japan, I kind of expect there could be a U-turn if necessary. I do expect that, so I think it's really hard to forecast what's going to happen there. I think they're trying to raise it very slowly, like you mentioned. Theoretically, that could impact rates increasing in other countries depending on how high they go. But I'm not paying too much attention to it right now because it's not so obvious that it's impacting us that much.
Okay. All right. And like during this market cycle, right? It's of course unpredictable. There's no one knows exactly what's going to happen. Of course, more chances of, as you said, a recession coming, into play, maybe by mid of next year sometime, or maybe later.
Probability wise, right now, the mid part of the year, June, July, August, I would say June, July is the midpoint of average time you would expect when a recession would start based on a lot of indicators put together. But the wild card is stimulus, and most of those previous cycles that point to that don't necessarily have the mix of stimulus, the degree of stimulus that this administration has right now. So that's where it makes it harder to predict.
Yeah, and it's not only this administration, right? It has been going on for past like 3-4 years before COVID started. A lot of money printed, pumped in the economy.
Yeah. To be clear, I don't vote. I hate politicians. I think they're all corrupt. I mean, I'm making a very general statement, but I'd say that applies to 80 to 90% of them. So I'm completely jaded with that. And so when I say this administration, I'm not pointing a finger. I don't care who it is, honestly. I'm just looking at what they've chosen to do over the past few years and what might so I have to take that and use that as like, what could they do next year?
Yeah, me too. I'm neutral. I'm not leaning towards any. But in general, as I said, as you mentioned, right? In general, the administrations, whoever were in Washington for past few years, they have printed a lot of money, pushed, try to stimulate the economy during the COVID period, and that's why we are seeing those housing prices being inflated. Not only housing prices, everywhere. The inflation is everywhere.
Yeah. Even in 2018, Trump had put a lot of stimulus in play in 2018 at a time where it was very unusual to do so. It was end of cycle, and that extended the cycle for a couple of years. And it's no coincidence that we have a record long cycle right now. It's all due to the artificial kicking of the can.
Based on your assessment, right, of the data, what do you think, like how long this downturn will last? Yeah,
that is really tough to say. And I say this again because I'm a purist in that if I could just take the data and extrapolate it out, I would be very happy. But what I've learned the hard way is that, this money printing comes in, this stimulus, this program comes in, and all this artificial nature that didn't exist 20 years ago and 30 years ago is all coming in. And so I'm expecting a 12 to 18 month time just because that would be common. 6 to 18 months is common, but I feel like given how long this cycle has been, there should be a bit of a purge. Could last longer, could be shorter, but I mean, anything is possible.
And so during this period, right, as a passive investor, what are the things that you will put in place to protect the capital,
Yeah,
as well as your investors? Yeah.
yeah. So okay, so there's really only two buckets of types of investments I'm considering right now. And before I even get to that, what I'm personally doing with my cash in the meantime is I'm buying on the secondary market short-term treasuries, 3 to 4 month term remaining, to get the highest yield possible. And I've laddered
Okay.
them, and I've been doing this now for a year and a half. And so it's been going on for a while, and I continue to do that. And I'm able to get, like, the last time I bought 2 weeks ago, maybe I was at about 5.51, I think, could have been a little higher. So it's pretty significant. Plus, those are there's actually no state tax on treasuries, so it's very favorable for me in California. So that's what I'm doing with the cash, and that's kind of waiting. But the two buckets that I'm still considering, even though I'm mostly on the sidelines, are either some really unusual, unique situation where there's so much padding at the purchase that I don't have to worry about prices going down, because that's my number one concern, is asset prices being lower in 12 months than they are today. That's, I think, what the
Mhm.
probability scenario is.
Yeah.
So I'll give you an example. In 2020 to 2023, I've invested in a lot of tax abatement multifamily opportunities. So I didn't invest in any floating rate bridge loan deals at all. On the multifamily side, I did do fixed rate 10-year tax abated opportunities that just create an immense amount of cushion at closing. They're very unique. And so, and I can get into just example numbers and stuff, but that's one thing I've been focused on that got me past the finish line and being able to invest with just enough padding. And then the other, so that's one bucket of just a one example. The other
Mhm.
bucket is opportunities where I don't have to worry about the asset prices decreasing, but I have to worry about the predictability of the cash flow through a recession. So I know that sounds a little strange, because any piece of real estate is a hard asset with some type of underlying value. But I'll give you an example. I've been investing in ATMs since 2008, and I went through the last recession with them because I started in January 2008. And they tend to perform pretty well from my experience in the past downturn during a recession. Now, an ATM machine is literally a case and a bill feeder and a computer and a screen and a keyboard, and those are all depreciating to almost zero anyway. So I don't care if they depreciate more quickly or not at a certain period of time. I'm not dependent on any residual value holding. I am fully dependent on the predictability of the cash flow through a recession. And so I'm still investing in those because, in my experience in the past, they've done well during a recession, and I don't have to worry about the asset prices reducing. So those are two buckets and two examples of stuff I'm actively doing right now. But generally speaking, I'm on the sidelines.
Okay. So now you mentioned 10-year tax abatement, right? Can
Yeah.
you just expand a little bit more on that? Like, how does that
Yeah,
work?
yeah.
Yeah.
So, okay, I'll get into, it's a little complicated, and
Okay.
I'm just giving you my understanding as an investor. Hopefully, it's all correct. So basically, you can purchase a multifamily property at, on or off market, call it a market value, market price, whatever price, put under contract, and then the sponsor will have already pre-negotiated a structure with the local housing authority to convert. I'm going to use an average scenario. Convert
Okay.
half of the 50% of the units to income restricted. And in order to do so, because you don't want to reduce your revenues at closing to conform to that, you have to buy a property that is way below market rents, that not just the sponsor saying it is, but it actually is, because it's going to be
Hmm.
properly scrutinized by the housing authority. So if you find that deal and it's way under market rents, and you don't have to reduce the revenues at all because it's already below market rents enough, once you agree to convert half the units to income restricted going forward, which means that you can only increase the rents to maximum published amount available, like allowed by the housing authority each
Housing.
year, and they base it off of inflation from the past. So just to be clear, this is not rent controlled, in that it's not a maximum of 2%, 3%. I've actually been in deals where there's been 11 or 12% annual increase allowed, because it's based off inflation from the previous years.
Mhm.
So but you cannot just increase as much as you want. You have a maximum of what the housing authority will allow. In order to incentivize you to do all this, you basically literally eliminate 100% of the taxes, and so you get no reduction in revenue, huge reduction in expenses, flows through to the NOI. And by the way, I should say there's an equivalent of about 15% of expenses to deal with the housing authority each year in the structure. So you effectively reduce 85% of the tax value, essentially, right? The
Mhm.
tax cost, huge reduction. And so essentially, when you have same revenues, much lower expenses, your NOI goes way up. And what happens is that effectively in the deals that I've been in, if you can imagine this, I'm going to try to use easy numbers. Let's say that we're buying a building for 10 million. I'm normally in a larger building, but easy numbers, 10 million. And the NOI because of this change structure before closing is significantly higher. The appraised value by the agency lender is typically, so let's just assume 70% loan to value. So there's 3 million in equity, 7 million in debt. The normal scenario I've been in is that the appraised value before closing even comes in at around $14 to $15 million on a $10 million purchase. And what does that mean? That means it actually covers not just the original equity, but you often cover like an additional amount of like say there was 3 million equity, there's another 3 million additional equity. It's 100% equity coverage and usually 130, 40% equity coverage. There's the 14 to 50 million number. And so that padding to me is great, not because I'm like, oh, I now have a much higher basis in a deal. The way I look at it is defensive play, because if the value comes down a little, we have a lot of padding to where I'm not eroding into any equity yet. So if the value comes down a little next year, it's a defensive play. And probably equally as importantly, because we are now income restricted, we're the lowest cost rents on the block or, within the area for half the units. And what does that mean? During a recession, we're the most in demand, relatively speaking, units because we're the cheapest, right? So it's a defensive play going into a recession for half the units. The downside is that you cannot maximize rents on that property for the next 10 years because you're not allowed to just rent increase as much as you want on half of the units that are income restricted. So hopefully that it's a kind of complicated, but hopefully that all makes sense. So it's a huge amount of padding at closing without any operation or executional risk, and provides a lot of downside risk protection going into recession, and provides a lower rent level going into recession for an average client.
So what I say is like an instant equity buildup, if you just do that conversion. Is there any way you can, after you have negotiated that with the housing authority in the midway, like after 5 years, is there any way you can just pull back out of the contract, or you have to stay there for 10 years?
It's all up to the sponsors to how they negotiate the contract, right? And often there's a clause in the deals I invest in, there's been clause in the contracts where you can choose to revert to a non-income restricted building at any time. There's penalties associated with it, but you can actually choose at your own discretion to be approved by the house. You can wake up today as a sponsor and make that choice, right? And so, yes, it's typically an option, but that's up to you to negotiate. Remember, I'm a limited partner, a passive investor, and I don't do any of this, but with the sponsor I've been investing with, they've negotiated all that.
Great. And now let's switch the gears a little bit, right? Normally, let's focus on the different kind of assets that you have invested, and what is the best in the current market cycle? What do you think is the best one?
Yeah, great question.
Moving forward.
Yeah. So I've invested in every major asset class except for hotels. So, I mean, I can give you the laundry list if you like. So actually, I might as well, just to clarify. So I'm currently invested in apartments, student housing apartments, retail, office, industrial, RV park, mobile home park. Senior housing, assisted living. The one thing I'm not in right now, I don't think any exposure, is single family. Normally, I'm at least do hard money lending in single family, which I stopped once the interest rates started to go up. Often I've been in the past in single family buy and hold or single family flip as well. So I'm very diversified purposefully. I love diversification. Now, if you take a look at what I'm looking for, there's 1,000 ways to invest, none of them wrong. But for me, I'm looking for a longer term predictable cash flow because I live off the cash flow and I don't want that to change. I want to go to sleep tonight, wake up tomorrow, and not much has changed. So that requires a diversified tenant base with an experienced sponsor in an asset that I believe has a lot of predictability for the next 10 years. So my tier one assets for the next 10 years at the moment are apartments, self-storage, and mobile home parks. To me, those are and self-storage, everything always depends on location, obviously. Self-storage in particular. But those three asset classes, to me, I can kind of foresee a very predictable demand for the next 10 years in the right locations. When it comes to office and retail, office is hard to say where that's going to be in a few years. They're back, return to work, not return to work. Other technologies to work from afar, suburban versus urban demand are, it's constantly changing. It's also very difficult to invest in those because there's constantly tenant turnover that you may not expect, with tenant improvement money required that may not be reserved correctly if you have a lot more tenants leaving than you anticipated, and that can impact cash flow. Same thing with retail. I don't necessarily dislike retail, but it's hard to predict where retail will be in 10 years and what the changing requirements will be and the habits of consumers. But furthermore, you have those tenant improvements that may be needed, sometimes for a good reason. You have an extra tenant you didn't expect, sometimes for a bad reason. More tenants turn and left, and you have to now fill them up again. That can disrupt cash flow. So there are some second tier asset classes I'll still be looking at and considering, but you asked me the ones that I really like the best, and those are the tier ones.
Okay. Yeah. I also like the same, multifamily apartments, storage, and flex space. Have you explored what do you think about flex space?
Yeah. So one of the challenges with flex space is that I look for a lot of tenant diversification.
Yeah.
And yes, there's typically diversification within those properties, but I like to be, and this is a random number I chose a long time ago, 13 or more tenants. And sometimes that's just not possible to find. The other thing that concerns me a little bit about industrial is that I've had a hard time figuring out where the demand is going to be geographically in a long term, right? So I'll give you a great example of what started to bother me. I used to live in Los Angeles, and we had something called Amazon Prime Now, not just Prime, but Prime Now. And in certain large cities, they were offering 1 to 2 hour delivery, 24 hours a day. That was Prime Now. But it was the essentials, like a Band-Aid, like Polysporin, something you may need all of a sudden, like, Benadryl, something you might need all of a sudden that you don't want to go out for, at 12 o'clock at night. And that is warehoused in a small location, somewhere very close to you, if it's getting to you in an hour or two, right? It's not in their regional distribution center. And so I started to get very confused as to like, okay, which way is retail heading? I'm reading about drones and other types of delivery. There was also self-driving cars and how that can impact and all that. So to predict where the industrial demand is going to be in 10 years is very difficult. Someone probably knows much better than me because I haven't tried to figure it out, but I've been concerned about it.
And when you talked about the multifamily, right? What we have seen while we have been looking for the good deals in the market, especially in the North Carolina, South Carolina, Florida, and Texas market, we still find like it's finding a needle in a haystack. Recently, it's very hard to underwrite a deal because the seller's expectation hasn't still come to par with the current market, and the spread between the cap rate and interest rate doesn't let us underwrite the deal properly. What do you think about that?
Yeah, I'm really glad you brought that up because that's what I was going to say. If somebody says to me, when do you know to invest? Again, like how are you going to know it's a time to invest? I'm going to say positive leverage. I'm going to look for 125 to 150 basis points positive, which is actually what I was getting in those tax abatement deals. By the time you switch the NOI, that's actually what came out to. So to your point, as an investor, there was a lot of negative leverage in the past few years. And I just looked at that and said, what is everybody doing? And granted, some of those are really heavy value adds, so that can make a bit of a different equation. It's not what I do. But for me, in more stabilized deals, that makes no sense and continues to make no sense because the sellers have not adjusted enough to the amount of change in the interest rate. It hasn't happened enough yet. It's going to be forced through distressed when there is comps that reprice markets. And we are still in the the bottom of the first inning on that process happening, because most of the forced distress is going to come in 24 and 25. 3-year bridge loans that were actually taken in 21 and 22. It's easy to forecast. 24 and 25, those properties will be in trouble. Some of them have been proactive to try to get rid of them early, and that's what we've seen so far. And that's why we're not at the top of the first inning, but now we're at the bottom of the first inning. There's a long way to go until we really discover true pricing and sellers are really forced to sell at the right price.
Yeah. And based on this current scenario, right? What is your best advice for the investors who are looking into investing in real estate right now?
Yeah, I would say a couple of things. Number one is real estate moves slowly. It's the exact opposite of the stock market.
Yeah.
So it is better to be a little too late than too early. So it is not a rush. And I cannot stress that enough, because I saw people going early in 2008, 2009, and some of them got burned just because they went in too early because the reductions weren't enough yet, and it kept going down, right? That's number one. So don't be in a rush. There'll be plenty of opportunity. And again, it's better to be late than to be early. Number two is absolutely pay attention to that spread between the cap rate and the interest rate, because what that essentially tells you is how much of a risk premium are you being paid as an investor to take the risk of being in that asset class versus the cost of borrowing. And for some reason, nobody seemed to be paying any attention to that for the most part in the past few years. And now it's something to very seriously pay attention to. I was always paying attention to myself, but now that people are trying to be conservative, it's probably one of the first things I would tell people to look at that a lot of people don't pay any attention to, unfortunately. And that will help guide you as to when the timing might be better and when you're actually getting properly rewarded for the risk. Unfortunately, we've seen Class C have a much quicker price adjustment than A and B, but I don't think any of the asset classes are done. And be very careful for recessions, because there's been a lot of talk about interest rates and the impact, because they become very clear. Very few people have still yet are discussing the recession playbook. And I'll go over it very quickly. During a recession in real estate, typically revenues go down, vacancies go up, and you have, in this environment, increasing expenses at the same time. And what does that mean? Lower net operating income. What does that mean? Even at the same multiple, you have a lower asset value. That's what I'm very concerned about. But there's a compounded effect that may come up. If we have a recession, the other typical recession playbook is a stock market crash. We haven't seen that yet. Normally that actually goes down in two phases. Phase one's already happened. We're not at the previous peak. There's still to be a phase two reduction. When that happens, more people will be scared, less people interested in investing. And that's when cap rates will probably go up the second time. The combination of lower NOIs, but people scared, less equity available to invest. A lot of people read about a lot of dry powder on the sidelines. That is somewhat applicable to institutional, completely not applicable to non-institutional. Totally false for non-institutional. It doesn't apply. And we're focused on non-institutional, what we're talking about today. So that doesn't exist. So be aware of the fact that there's very possibly going to be that second domino to follow with the recession, and we haven't seen the impact yet.
And talking about the stock market, right? For past maybe year or so, the stock market is on the sidelines, like, around 34,000. It has been playing up and down 34,000.
Yes.
No major movements. So it's just a ticking time bomb when it happens.
Yeah, and it's a common pattern. If you look at previous patterns, it normally goes down, kind of goes sideways, and then maybe it will go up a little and then down, right? And that final crash down. So, and again, we don't know what's going to happen, but looking at the probabilities, that this is completely normal.
Yeah, that's true. All right. So, Jeremy, let's change the gears a little bit. We'll move to the final round of questions, keeping time into mind. So just to start with, can you tell our listeners what are your major source of information?
Sure. I do a lot of reading every day. I do 2 to 3 hours of reading every day, sometimes more. And what I try to do is get a mix of mainstream media, but also just trying to get out of the weeds of the media and looking at the data. So the mainstream part, I always look at CNBC to just understand what people are reading, because it's the most trafficked business site, I believe, and what they're really saying in terms of narrative. I have on my phone, I have an Android phone, and the Android phone on the homepage serves me a lot of stories, and it kind of tailors it to what you normally read. So that ends up hooking me off to a lot of sources: Yahoo, Finance, MSN, Business, and Forbes, and some other ones, Wall Street Journal, and all this together. What I do also, though, to try to get out of the weeds of the media is I look at something called Zero Hedge, which is a very alternative. I would say, unfortunately, half or three quarters of the article is a little conspiracy theory-ish. But these are Wall Street guys that started this website in 2009 to really get through the weeds of the data and the media and actually parse the data truly and tell you what's really going on. They're very good at that. So if you're looking at like what was going on underneath the jobless claims, what's the real numbers? What do they tell you? That's where you want to go. If you want to see, okay, the GDP print was very high last quarter, but why? What's the mainstream media not telling you? A lot of government spending caused that, right? So they'll actually parse it out for you. So I would strongly recommend them, but just be careful on some of the articles that are a little out there. I also really like calculatorriskblog.com. If you just want to be able to see data releases that is put into a chart with very little commentary, so you can just look at a chart. They create their own chart, a lot of historical data, like they kind of keep many years of themselves, the charts that they're building themselves from the data. If you want to just look at it objectively and be able to read it yourself and look at it from a distance, I find that's a very good site. It's a little optimistic sometimes, but generally speaking, I think it's quite good. So those are some coming to mind. I look at all other different sources too.
Right. And which is the one book that you'll recommend, which has a major impact on your life or your investment strategies?
Yeah. So I actually recommend two, but it's kind of the same. So I always tell people to read Robert Kiyosaki, Rich Dad Poor Dad, and Cash Flow Quadrant, but in that order. So Rich Dad Poor Dad first, Cash Flow Quadrant second. Some people don't read Cash Flow Quadrant. Strongly recommend that one as well.
Okay. Yep. That's the must-read book, right? For
Oh yeah,
any investors, especially
yeah,
the passive investors.
especially.
Yeah. 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 How do you like to give back to the world?
It's a great question. So I do a lot of calls. I don't charge money just to try to help people because I'm very lucky because I have the time. So I do free calls with people who are just either new to the space and want to brainstorm to contact me, or I actually help sponsors structure things, or they maybe throw their structure like they just float it to me, brainstorm it. I help. I actually am very big on helping people with my time. And so I'm on many calls every week of those types to try to help to give back. I also created the nonprofit in 2007, For Investors by Investors. And the purpose of that was to have investors unite, network, and learn from each other for real estate in no sales pitch core foundation. And so we lose money off it every year, but it's manageable. And we try to just break even on the cost of the venue, but without very strict no sales pitch foundation. Out of that, I co-founded something called Intelligent Investors Real Estate Conference, IIREC. We've had several, I think 5 years of conferences now. Again, we are very careful with sales pitches, have very few sponsors. Because of that, we actually lose money every year also, but it's been somewhat manageable. It's been harder, but that's just to unite investors in a non-sales pitch type of conference. And we just, we know every single speaker for many years. Personally, we're very careful with that too. So these are just some of the ways that I try to give back. I'm very lucky. I have a lot of experience in the space, and I also have time to give back like that.
That's great. And these conferences, are they online or in-person conferences?
No, these are in person. We did do one online during COVID. The last conference we had was earlier this year in Salt Lake City. It was just one day before the Best Ever Conference. We partnered with them to do our conference first in their venue, and then they did their conference. I don't know what's going to happen next year. The constant struggle we have is that it's very expensive to run a conference, and we do not want to end up with a ton of sponsors to avoid the sales pitch. So it's always been a challenge. So we're still working on next year.
Yeah, I was there at the Best Ever this year.
Oh, good. Best Ever Conference is fantastic. It's
fantastic.
One of my favorite conferences every year for sure.
Yeah, a lot of networking, a lot of things to learn.
Yep.
It's good. Yeah, it's worth time well spent.
Yes.
Yeah. And final question, Jeremy, how can Decoding Cashflow listeners get in touch with you?
Yeah, sure. Anyone's welcome to contact me. Best way to reach me is my email. So it's jroll, JROLL, at Roll Investments, ROLL, investments with an S, so it's plural. So jroll at rollinvestments.com.
Sounds great. All right, Jeremy, thanks a lot for taking out some time. It was a pleasure talking to you. There's a ton of information that you had provided to our listeners, and there will be a lot of takeaway from there for them to take from the show.
Yeah, no, thanks for having me on. I appreciate it. Whoever stuck around to the end, we appreciate it. And hopefully this was helpful for you.
Yep. All right. Thank you.
Thanks for listening to Decoding Cashflow, brought to you by Aster Capital. If you found value in this episode, then please share it with someone who you think could benefit from it. And make sure to act on what you've learned. If you want Ted Patel to personally help you reach your goals, then feel free to set up a one-on-one call with him. Also, visit us at astercapital.com for more free resources. Content of this podcast is for informational purposes only. As always, please consult your own advisor before making any investment decisions or setting a course of action. Thanks again for joining us on this episode of Decoding Cashflow, and we'll catch you in the next episode.